Welcome everybody back to What the FICC. What the FICC, man? Ian, what the FICC? What's up?
Hanging out, just getting back to the grind. It's a nice long weekend in Miami, celebrating with family. Pretty wild city. Have you been down to Miami?
I was in Miami, I don't know, 3 or 4 years ago. It was the last time I was in Miami.
Amazing town.
Yeah. Well, long weekend for you. Long weekend for the rest of us. Next weekend, by the way, we do have a big holiday coming up. It's very soon, but we're not here to talk about that. We're here to talk about what's going on in the FICC markets. Of course, that is fixed income, currencies, and commodities. There is a lot happening right now. There are times, Ian, where to the layperson, to myself, these markets are not, shall we say, not the most interesting. And there are times where they are definitely more interesting than like stocks, for example. I would argue that what is happening right now with the US dollar and rates, interest rates, are more interesting than what's happening in the stock market. So let's pull up some charts here. Maybe we'll start with the US dollar index, DXY. Explain to us what's going on here and why it is so important.
Well, I think the reason the dollar and rates are so interesting right now is because the negative correlation with equities, with the stock market. A dollar failed breakdown in July. This is what's highlighted here in this first chart with that green circle. Ripped higher into last month, and now it's starting to roll over. And yesterday we saw a big down day, down almost 1.5%, which is a huge move for currencies, huge move for the dollar index. And stocks loved it. Stocks absolutely loved it. So just wanted to first show this zoomed out chart, this 102 level. Now 102 is not the level we're really focusing on right now. I'll get to that in just a moment. But it shows the shelf of former highs, that failed breakdown, and the rip higher. So we're now zooming in and highlighting yesterday's breakdown. Now the 105 level is really what we've been focusing on. It coincides with a former shelf of highs going back to beginning of this year. That former resistance turned into support this fall, and it coincides with a key retracement level. So a lot going on. So to see the dollar index take out this level, it's a big deal, Spencer. It's a really big deal.
Why?
Because it's a confluence of potential support. And when that support doesn't hold, selling pressure, I imagine selling pressure is going to increase. And just the fact that, yesterday was such a big downside thrust. Man, I think we have more selling to come here for the dollar.
Boy, well, that will be good for stocks, though.
It would be amazing, not only for stocks, just risk assets more broadly, stocks within the U.S., stocks outside the U.S., just global equities. Period. Even some commodities. We've seen copper. We've seen the copper mining bellwether, Freeport-McMoRan, FCX, dig in and hold above support and start to catch higher. It's extremely constructive. We're moving on to slightly more zoomed in chart here. The 104.38, 104.25 level is another key retracement. We measure the recent rally off of those July lows. Now, slice through that level again yesterday, finding a little bit of support there today, but I don't want to give it too much credit here. It makes sense to see the dollar pause after such a steep decline, a single day decline. So I'm still keeping an eye on this 104.25 level. We're right around there now. And then, looking at 103.50. But, like you just mentioned earlier today, Spencer, keep lowering the bar, the support level for the dollar. And that alone is information. And just looking at small caps, and some of the most beat down areas of the market catching a bid really reiterates how strong the negative correlation between the dollar and equities has been.
All right, so let's talk about. Oh wait, no, we have one more chart. This is the daily performance, which I think is interesting.
Yeah, this is just highlighting that the strong rate of change yesterday, down almost 1.5%, and then highlighting last fall. We haven't seen a move like this since last fall. What happened last fall? Dollar peaked and rolled over. So
and stocks bottomed and started to rip.
Stocks bottomed and started to rip, and the Nasdaq 100 had its best first half in its history. So we'll see, and we're entering a seasonally bullish period for equities. So everything's just kind of coming together, right? Volatility's out the window. Equities are catching higher. The dollar's rolling over. Rates are easing.
What's the VIX at? 14? Is the VIX at, well, yesterday? Was that no, it was lower like a couple months ago, but this is at like a near a 3-year low for the VIX, near a 3-year low. So what should we do about how to play this now? Let's talk about that, right? So we have a dollar that is potentially rolling over here. We've talked about that being a tailwind for stocks. What about some currency pairs, or maybe how would you go about playing this or putting this into context?
Well, first, the euro 57.6% of the US dollar index. So if the dollar index is going to roll over, which it is, the euro will likely benefit the most. We saw a big move you see here in the euro yesterday. The only problem is that 107.50 level is kind of come and gone. So if you haven't jumped on a long position in the euro, the ship has kind of already left. If you want to trade against that level with an upside target of around 112.50, that can make sense. But if we look at a couple of other currency pairs, mainly the Aussie and the Kiwi dollars, we have really well-defined risk levels to trade against that haven't actually triggered buy signals yet. First, the Aussie dollar, still in a structural downtrend. That's the same story we're going to see here in bonds in just a few minutes. But it stopped going down and it's carving out what I perceive as a tradable low, right below this 65.21 level. Zooming in, that's it. You can see maybe potential, maybe we could call it an inverted head and shoulders pattern. Doesn't really matter. We got a base here, recently hit oversold. There's actually a bit of a bullish divergence. So I'm watching the momentum. I like to see an overbought reading, or at least a new high in terms of the 14-day RSI. But I like the Aussie dollar long above 65.25 with an initial target up around 68.75. So on the verge of breaking out. If you remember, it was just, a handful of months ago. What was it? Towards the end of the summer, when we were looking at these charts and highlighting potential bearish flags, like short duration continuation patterns. And we had these downside targets, never reached those downside targets. Instead, prices carved out, again, a tradable low. It's the same for the New Zealand dollar. Very similar picture, kind of makes sense. They're neighbors, both commodity sector centric currencies, both trade partners with China. Zooming in, the level for the New Zealand dollar is 60. Let's call it 60.25. Right, very similar pattern, not quite as clean as the Aussie, but very similar. And I like seeing the Kiwi here, the 14-day RSI on the verge of hitting a new multi-month high. That's if and when the Kiwi takes out that this overhead resistance here, this polarity zone of former support turned resistance. I like it long, targeting 63.75.
All right, what would a rolling over dollar mean for the bond market? Let's look at some bond stuff here.
Well, the dollar and rates have been highly correlated, and that correlation, like the strong negative correlation between the dollar and equities, is still intact. Dollars rolling over, we're seeing rates start to retreat. What's interesting, I wanted to highlight this chart. Wrote a little bit about it last Friday. High yield bonds, investment grade bonds, and treasuries all dug in around the October, or the last year's lows, last year's summer lows. TIPS, inflation protected securities, did not. They undercut their respective lows. So seeing that relative weakness in inflation protected securities is kind of like heads up. It's kind of, the bond market kind of tipped its hand in that maybe investors didn't need to protect themselves from inflation. And sure enough, CPI came out and rates are rolling over, right? Rates are rolling over. We got the 5-year pulling back towards a shelf of former highs here. 10-year and the 30-year aren't quite there yet, but when it comes to actually trading a tactical bounce, and again, when I look at these charts, when I look at a bond chart, for me, the trend is still lower. It's hard to argue otherwise. Nevertheless, big support levels, former support levels coming in. So you're checking out this TLT chart, the shelf of former lows going all the way back to the early 2000s with the inception of this bond ETF. TLT found, it's like clockwork, Spencer. I know you shake your head. It's amazing how technicals work. And what's also interesting in the lower pane here, we have a 4-week rate of change. And what I like about this is when you see these strong upthrusts in rates of change here, upside rates of change, that's often followed by a pullback, but also often followed by to varying degrees. Right. And we saw that, during the financial crisis. We saw that in 2013. We saw that in 2020. We saw it earlier this year. Now, on the flip side, looking at momentum, when we get a strong oversold reading, a deep oversold reading, that's tend to be followed by a nice bounce in price. Again, we saw that early 2021, saw that in the spring of 2022 and the fall. And I think we're seeing that right now. We're seeing that right now. Now, zooming in, here's TLT. I see a potential, inverted head and shoulders pattern. A lot of those patterns out there forming, which is interesting. Also, bullish divergence in the 14-day RSI. I think, if TLT is above 88.5, I like it long all the way back up towards 99, 97, in that ballpark. I'm going back and retesting this shelf of former lows, potentially a little bit of former support turning into resistance. We tend to see that principal polarity come in more often than not. And it's a similar picture when we look at the 30-year T-bond. Now, momentum hitting a new multi-month high. That's a good sign for the bears, the bond bulls here, for some further upside action. Again, another bullish divergence in momentum. We'll invert head and shoulders with an upward slanting neckline. Now, 30-year T-bond has come off quite a bit today. It's well below that 115.08 level. Nevertheless, I think you can hold out and wait for an upside resolution above there. Or if you want to buy weakness back towards 112, 112.15. That works as well. But if we could break above 115.08, like a long back up towards another, again, an area of former support turning into resistance here at 121.31. Let's call it 122. 122 for the 30-year T-bond.
If you go back to that TLT chart that shows the whole history of this thing,
Yeah.
I was mostly just shaking my head at the fact that it took 17 and a half years to go from 80 to 180, and then 2.5 years to go from 180 back to 80.
Yeah.
Like 17 and a half years on the way up, 2.5 years on the way down.
Extreme.
Just,
It's been an extreme sell-off for the past few years. So to see a period of digestion, of consolidation.
well, we've had that. I mean, we had that a couple years ago. We had that, did we not? No,
not really. I mean, not since the peak in 2020. I mean, it's really just been rolling over. I can see a period where bonds just do nothing. Maybe bonds start to look like the other side of the left side of this chart. From 2000, to, or say 03 to 07. Where it just they kind of chop sideways. I think if we're in an environment like this, equities are going to do very well.
Right, because that's healthy.
That's healthy. Yeah, exactly.
Right.
That's healthy. Bonds aren't supposed to be the center of attention. Like you said,
right.
It's not often that these areas of the market are exciting
Right.
or interesting. Just the
Right.
fact that they've been catching a lot of attention, that everyone knows about the Fed and the CPI and this and that is just information itself. So yeah, let's, hopefully, not even hopefully, I can foresee a long, prolonged basing period or digestion for bonds here over the next several years. We'll see. It's too early for me to come out and say this is a bottom in the bond market. I need a little more than just a month or two of price action, but I think couple months of price action, it's enough to get behind a long position in terms of a nice tactical bounce here. It's enough to get behind and want to get long back up towards 99. Let's see what happens, when it gets to 99.
Derek the trader in the chat asked. Derek the trader asked about UUP. You have DXY, which is the same thing. I'm assuming I'm looking at UUP right now, and it looks very similar, not quite identical, but very similar to the DXY chart. So
yes. So what is the question regarding UUP? Let me check.
Can you just check it out? That's the question.
Yeah,
so, but it looks like that, right? I mean, that's what it looks like.
Yeah, it looks just like this. I mean, I don't trade UUP. Are you asking in terms of highlight some levels to trade against?
I'm assuming so. How do you trade? How do you trade the dollar? You don't trade the dollar via UUP.
No, I trade the futures in the FX markets.
Right. There we go.
Let me move this out of the way, guys. I'm gonna pull this up. Optima's gonna pop up. All right. Sorry.
Doing some on the fly.
Some
on the fly analysis here. And then what we'll do, where was the question about? We had a couple Forex questions. We will address those on Friday's show. I'll write them down.
Yeah.
We had a question on the yen and the CAD, and we will just do it on Friday. So for the rest of these. But UUP, I figured we're talking about the dollar. Might as well talk about UUP for a second.
Yeah, let's check out UUP.
Yeah.
I don't really look at UUP that often. But I will highlight some levels for you real quick. Spencer, meaning to mention this, I think it would be fun to incorporate some live charting.
I'm all about live charting, man.
I was talking, had a great conversation over the weekend with a viewer, and they were hoping for some more tactical, like shorter term charts. I think the way we're looking at some of these things are pretty zoomed out for their
Yeah.
liking. And
Yeah.
I would love to zoom in and look at anything that our viewers and readers would like to see.
I'm for it. I'm for it. Yeah, you guys know I love live charting. I think live charting is way more fun than, as much as I respect you guys and the standards you have for your charts, and live charting can be a little bit messier, no doubt about that. And but for short-term tactical stuff, I think live charting is important. We can talk about that offline. All right. So we'll do UUP and then we'll hop off here. Bottom line here, everyone, is dollar rolling over, and that would, if historical correlations persist, that would seem to be a good thing for stocks. So that's sort of my biggest takeaway here is watching the dollar, and then basically on any given day when the stock market is up a lot or down a lot, the first thing I will do is look at what the dollar is doing, just to make sure that the relationship is still intact. You know what I mean?
Mm-hmm.
So it's a very good indicator. What I should get in the habit of doing more is looking at the dollar before I look at what's happening in equities. But the dollar is further down on my screen, and my eyes don't go there first. So my eyes usually go to the equity futures market first, but that's okay. Okay. And then, so what we'll do with Friday, all right, so Friday we'll talk about the Canadian dollar, we'll do the yen, and we'll do the we'll do the Polish zloty a little bit on Friday if you guys insist. I don't know.
Really?
And
Are we really gonna do
I don't
that?
know.
We can do it. We can do it.
I don't
Yeah,
know.
we can look at this
Only one person I know cares about the Polish zloty, and he's not here. But
bring them on. We'll have fun. No, I'll bring this one.
yeah.
Why not?
Okay. Good stuff. All right.
So yeah, I mean it's a very similar chart.
Yeah, I mean it's UUP is just a dollar ETF. It's the only dollar ETF, right? There's only one, to my knowledge.
Yes,
So,
I'm not familiar with any other dollar ETFs. I'm gonna highlight this retracement level here. Here we go.
as
I'm just
always,
gonna lay it right on top of this chart.
yeah, dude,
How
just
about
drop it
that?
right on top. Drop it right on top. There you go. Look at that. Beautiful.
Center horizontally. I'm gonna center it vertically. All right.
Boom. It's clean. Look at that.
Mm-hmm. So yes, it's pulling right back to that retracement. So it's interesting. Another key level, that coincides with that 105 level we've been watching from a retracement level perspective. But we still have the shelf performer highs all the way down here around 28 and a half. I don't really get any other information by looking at UUP. It doesn't really add any value to my interpretation of the dollar. But in terms of trading UUP, I think it can be short below 29 and a quarter for sure. And with some potential support coming around 28 and a half. Things really start to open up below 28 and a half. And just looking at the dollar index, I mean, it's back in the box. It's messy. And I anticipate, I don't expect, but I anticipate further selling pressure after a day like yesterday. I think that's where we're at, Spencer.
All right. That'll be a good place for us to wrap it up here. We have a lot happening in FICC land. We'll keep an eye on it. We'll be back, of course, on Friday, same time, 12:30 p.m. Eastern time. Ian Cully, he's the head of FICC at All Star Charts. If you want more of his stuff, you can look at his blog. It is down below in the description. You can always email us with questions. The link to email is on the screen. And if you want all of Ian's research, the only way to get it is to join All Star Charts Premium. The link to that is down below as well. That's all I got, Ian. Anything else for you?
No, that's it from me. Enjoy your
All
day.
right. See you guys.
Thanks for watching.